Thank you very much for having us here. This is a wonderful event. I've always felt a lot of MBA students come to the MBA program. It's a 2-year program, and you think academically it's terminal, okay? You go off and do out to practice. But one thing you might keep in mind, and I hope this seminar invigorates you, you can always also do a PhD in business, okay? And actually it doesn't pay too badly. And it's very fascinating. You're your own boss a lot of the time. You have a few deans to deal with, but it's very interesting work. So I hope you're stimulated by this discussion. And if anyone wants to think about doing a PhD, come and talk to your professors, okay? Because we love to work with bright people getting a PhD. Okay, the title of this is Accounting for Value, and this is the title of my recent book, and I'm not going to spend, I can't talk about everything in the book, otherwise I'll be here till the next seminar. But I want to talk about just a few ideas. Have you got the... I thought I might start with sort of give you some general idea of what accounting research is all about. I'm a professor of accounting. Some people sort of wonder, well, what do you do in accounting research? When I came off to graduate school to come and do a PhD, I said to my dad, Dad, I'm going to do a PhD in accounting. He said, a PhD in accounting? Can you also do a PhD in plumbing? And I said, no, but you can do a PhD in real estate. And he said, oh, in my day we called that geography. In any case, it turns out that there are very many interesting issues in accounting. Accounting really is applied economics, and particularly applied financial economics, okay? And just to put you into the ballpark, really the two questions that we look at in research is, first question here, hey, what's good accounting and what's bad accounting for a bank, okay? What's good accounting for management? This is a very important policy, very, very, very important issue. The second issue is, given I got the accounting, how do I handle it, okay? Those who take in my financial statement analysis course, this is what we think about. How do I handle the accounting for equity valuation, okay? How do I handle the numbers? What am I going to watch out for? What am I going to watch out for, and so on? So these are the two questions which we're involved in. I want to talk my own research, just a couple of aspects of it. I'm very interested in the equity valuation, okay? So Microsoft trading at 24.5 is a reasonable valuation or not, okay? To put it simply. That's equity analysis. And I pick up the financial statements and think, what can these do for me, okay? How do I handle them to get a handle on that question? And somewhat reversing the order of the questions on the previous slide then is, if I want to do that, if I want to really think about whether 24.5 is a good price for Microsoft, how do I, what's good accounting, okay? What do I want my accounting to look like? Because it can mess me up, okay? Or it can really help me. So that's sort of the questions I'm involved in. And I want to give you two examples of just two issues which I've been involved. One concerns a very important current issue, and that has to do with fair value accounting. Okay, if you know anything about the history of accounting, in the 1920s, accountants used to write up assets in the balance sheet to so-called fair values, okay? And then we had the crash. And the likes of Benjamin Graham from Columbia said, it was terrible accounting, they put water on the balance sheet, okay? Never again. And the Securities and Exchange Commission in the United States has always been of the disposition, no fair value accounting in the balance sheet, okay? No water on the balance sheet. Until about 1990. Mm-hmm. And the big change was when the SEC gave Enron the permission to use fair value accounting, and they basically built a fair value accounting house of cards, okay? So that's the question. The question would be, do I want fair value accounting? It's an issue of the day. Well, from the point of view of an equity analyst, I've got to think, well, does it help me or hinder me? And to do that, I've got to ask the question, how do I handle accounting? What's my model for handling accounting? I have a model for handling accounting, a particular model. Then it's a question within that model of handling accounting, this helps me or hinders me, okay? The book Accounting for Value is really about outlining that model of how you handle the accounting and equity valuation. Mm-hmm. And then it asks, one question it asks amongst many is, if I'm going to handle it in this way, is fair value accounting going to help me or it's going to hinder me? Okay, very practical question. And I guess the example would be, and the way that it goes on is, essentially, if you want to do valuation, you've really got to have a balance sheet which you can trust. Okay, it's a very important part of valuation. You have a balance sheet that's going to come back and hit you, okay, because it has all off-balance sheet liabilities and debt. Okay, there's a balance sheet you can't trust. Notice every time we have a financial crisis, some acronym turns up. Okay. A VIE, an SPE, an SIV, whatever, okay? They're off-balance sheet mechanisms, okay, which are permitted by the accounting. They turn up and hit you. But the question here was more on the asset side. If I've got fair value accounting, in the particular way we want to model how we handle accounting and equity valuation, do I want fair value accounting? And here's the, I guess, a recent example. Enron would be a case would say, look, it actually didn't help me, okay, in Enron, the fair value accounting. But a more recent example would be, I'm investing in a bank, and the accounting rules say that if I make loans, I'm originating bank, and I put those loans in a portfolio called an available for sale portfolio, I can mark them to fair value, okay? If there are similar loans trading elsewhere, I can refer to the market price. If they're not trading, I can estimate the fair values, okay? Now, let's say we're 2005, 2006, and let's challenge the paper of our colleague that says the housing prices are right, okay? Admit the notion that there is a housing bubble, and housing prices go up, and the price of these mortgage-backed securities and of these estimated value of these mortgages goes up. Then, on my balance sheet, I have these assets written up, okay? I have unrealized gains recognized. I have my assets written up. Is that going to help me? Well, under a model of how you handle accounting and handle the balance sheet, the answer, and there's a question what the appropriate model is for handling the accounting, the answer would be no, this gives me some problems, okay? Real appealing back to Benjamin Graham. People in my class have heard this, okay? When I want to really do analysis to challenge the price, I don't want price in the calculation. I want accountants bringing prices into the financial statements. If I bring bubble prices into the financial statements, I lose the ability of the balance sheet to give me an anchor to hold me, okay? I haven't got a balance sheet I trust. So there is sort of implication of a model first, worked out a model first of how you handle the accounting, okay, as a prescriptive normative approach to equity valuation, then with implications for the accounting that I want to that I have. The second example is maybe closer interest to you, particularly those in finance, is an issue on value versus growth investing. This is an issue that has absorbed researchers and practitioners, investment practitioners. History of the data shows that the returns to value and the value versus growth stocks differ on average, and the question is why they would differ. What this research does is indicate that the explanation, I should say, may be in the accounting, okay? And here it goes. Here is the value versus growth returns. This is from the period from 1963 through to 2006. Every year, I rank firms on their earnings to price ratios, okay? And I form them into 5 portfolios, from low to high earnings to price portfolios. And you can see that, and then within these portfolios, I rank them on their book to price. And so I have 25 portfolios. I do this every year. And then I calculate the returns I earn on these portfolios over the next 12 months, over the next year. And then I average it over all the years. Okay, for the 4 years here. Okay, this is the average returns I would have earned for this portfolio. This is really the demonstration of the value versus growth, so-called notion of investing. Firms with low book to price and low PE stocks, there's the return there, 4.3 on average. Those for high earnings to price and high book to price, there's the return here. You can see the firms' returns graduated here across these portfolios. Now, these are very large differences. 30% versus 4.3% as an average return is a heck of a difference, okay? Now, of course, we have to think about the risk of these portfolios, okay? And this is really the issue in hand. This has fascinated people in research, okay? Why do you have these differences? It's not explained by beta. It's not explained by the capital asset pricing model, okay? People have introduced the notion, particularly that book to price is a risk measure. If I started doing this, of course, every year, this, of course, is very simple investing, right? Your 8-year-old can do it. Get the price off Yahoo Finance, get the earnings and the book values, okay? Divide into other. You can actually perform this. It's not a lot of analysis. It's very simple. How can you have such good returns to very simple investment strategy? So this is the question. Well, what could be wrong here? Well, there's 2 things could be wrong. First of all, you have to worry about. First of all, with only using 2 bits of information, earnings and book value, you're in danger of running into someone who's using more information, someone who's done their homework. And secondly, you're really in danger of actually maybe picking up risk. It may be the firm with a low earnings to price, with a high earnings to price and a high book to price is a very risky company, okay? And these are just payoffs for risk. And so that's what this research investigates. Is in fact these are payoffs to risk. Now people have developed asset pricing models which said book to price is related to risk, okay? Because it's related to distress, it's related to liquidity and all sorts of other things. What we've done in our work is to ask, is there anything that has to do with the accounting which would indicate that when you're actually buying a high book earnings to price and a high book to price, that you are actually picking up risk, okay? By the way, just note one thing. People will try to sell you on investments by giving you their historical returns, okay? The mutual funds that advertise are always the ones that have done well in the last few years, okay? But people will actually give you the history of over a long period of time of this back testing, and it's usually on US very often US data. One thing we've got to remember that the last 50 years, this period here, is a very successful time in US history, okay? With corporations doing very well, a very successful stock market, and you would expect that in a very successful time, you would have done very well if you held risky investments, okay? Because risk paid off. So the question is whether these ones down here, even though they looked like so much bigger return, these paid off because it was just a period in which risk paid off very well. And if we run into a period where risk does not pay off well, like 2008, things might go in a very different direction. Okay? So the point before us as an accountant, I look at this and say, hey, hold it. These ratios, earnings to price and book to price have accounting numbers in them, earnings and book values. Given price is strictly correct to say earnings to price and book to price are accounting phenomena. And so, if these have anything to do with risk, it must be the way we do our accounting. It picks it up. Or, for some reason, the accountants are just doing crazy things, and for some reason, these numbers get correlated over this period with what matters, what matters for risk. Okay. But let's think about the notion. These are accounting phenomena. So, if in fact these have to do with risk, well, there may be accounting explanation for this phenomenon. Do these ratios pick up risk because the way the accounting is done? And there are a few insights if you understand the accounting. First of all, understand that earnings to price, of course, is a yield. So just as you expect higher risky bonds to have a higher yield, now it's a bond yield, but of course a bond yield can always be converted to an earnings yield by the effective interest method. Do you know that one? Okay, in your accounting 101. The bond yields are explained to bond yields or earnings yields for bonds are related to returns. That may be also the case for equities. Okay, so we take that into notion that yes, if you've got more earnings, more risky earnings are at risk, then you'd expect earnings yields to be priced such that the price is lower for a given risk for a given earnings. Okay, now that's easy to take on board. But the trouble with an equity, of course, unlike bonds, equities have growth. Okay, and growth actually depresses the earnings yield because you get higher prices, you expect more growth. And the issue, therefore, is can you see the accounting working in such a way that when you introduce the book to price in that 5x5 portfolios, this actually sorts out the risk. And as you work through the accounting, and you think how accounting works, the answer is yes. Book to price is typically less than 1, or price to book ratios are greater than 1. Okay? Think of the case where book to price is 1. Okay? If book to price is 1, book to price cannot indicate risk. Now, there's very popular models in finance that have book to price indicating risk. Okay? The book to price cannot indicate risk if the book to price is 1 for all firms. So take into account, for example, a money market fund and a risky hedge fund, and they're all mark to market, both mark to market. In that case, the book to price is 1 for both funds, and the book to price cannot distinguish. The book to price cannot distinguish the risk, and it cannot distinguish the risk because of the accounting. It's mark to market accounting, and it takes away the ability of the book to price to indicate risk. Now think of industrial corporation, where you say, no, we don't use mark-to-market accounting or fair value accounting variant of it. We use some form of historical cost accounting, which typically gives us book to price less than 1. Now, how do you get a book to price less than 1? The way the accounting works is, given price, which is the expectation of future earnings, you only get a book to price less than 1 if the accountants say, I'm not going to book all the value now, the earnings now, I'm going to defer booking the earnings to the future. Okay? That's how accounting works. So, a book to price less than 1 gives an indication of earnings deferred to the future, of earnings growth. Now take on the notion that growth, that earnings are at risk, and not only are forward earnings at risk, but long-term earnings are at risk. The more growth you have, okay, the more growth that is not yet booked into the accounting, the more risky you are. Put it this way, the way the accounting works is, we don't recognize earnings on the balance sheet until we have a very low beta asset, cash or receivables, until we get the resolution of uncertainty. That is, we all put into growth until we get the resolution of uncertainty. As it turns out, it's a little bit of a tricky explanation here, unless you've really got the aesthetics of accounting. If you put earnings to price and book to price together, you'll actually get this combination where you get situations where firms are reducing earnings now, deferring to the future, okay? You're picking up growth. And you're picking up growth which is at risk. Okay? It turns out that under the accounting scenario, or the way you look at value of growth, growth is redefined. Growth is risky and yields higher returns, whereas under value of growth labels, growth is supposed to be less risky and yield lower returns, okay? From an accounting point of view, once you see these numbers as accounting number, you realize that the value versus growth has actually been mislabeled. Okay? Growth's risky and growth urge a higher return, and a combination of earnings and price and book to price give you that indication of growth. And that can be explanation for these differential returns. And just to finish up very quickly, here now are the 2 years ahead growth rates for these portfolios, earnings growth rates. And you see the growth rates are much higher for these for these portfolios down here, okay? You also see that the standard deviation of EPS growth rates is much higher for these portfolios down here, which again are the high book to price and the high earnings to price. Growth takes more shocks. And you see down here, when you look at the interdecile range, which is the 0.9 versus the point minus the 0.1, you see the interdecile range here are far higher for these ones here. These portfolios down here, which exhibit those higher returns, are portfolios which give you higher expected growth, but where you actually take a lot more hits to growth, okay? You actually get more extreme negative outcomes, and you get more extreme positive outcomes, okay? And it happened over this period that we looked at these numbers here. Here is a period where growth actually paid off in the US because we got growth. But this is growth that comes with risk. And that, of course, is saying, I want to handle accounting, the earnings and book value, for the point of view of taking very simple positions as an investor, okay? And I can be naive about it. Let me just buy firms with low prices relative to book value and low prices relative to earnings, okay? And trust my luck. Well, we've got to be careful. You are actually buying growth, and you're buying risky growth. And that all comes from understanding how accounting works for valuation, okay? Which is the theme of the book, okay? There's many more stories there. The theme basically is valuation is actually an accounting problem, okay? You've got to do your accounting. And if you want to do valuation, this is how you do your accounting, okay? This is the insights you get from accounting about what you're buying and the risk you're taking on. Okay? Thank you very much.